Today, January 28th, 2026, the U.S. stock market achieved an all-time high of 7,002 on the S&P 500 index. This is the seventh high since the beginning of the year. From the April 2025 low last year to the current peak, the S&P 500 has increased an impressive 44%. So with this surge, we are all feeling good about our investments. We feel wealthier than a year ago because the market has basically handed out 3 years worth of returns in just 9 months. But if you look under the hood of this market, the engine could be overheating. I'm David Pettis, founder of Blue Rock Capital Investment Advisory Service. This recent rally in stocks has been phenomenal, but the data says the market could be getting extended. We are seeing a market setup that suggests it could be time to exercise caution. So what I'd like to do is walk you through the analysis that I use consistently to evaluate the health of the stock market and review specific yellow flags that suggest we could be getting close to a ceiling for stocks. I'm not going to give opinions or forecast, but instead I will show you some data for your consideration. The first yellow flag is the Fibonacci ceiling. So think of the market like a rubber band. If you stretch it too far, it will eventually snap back to relieve the tension. We can measure that tension in stocks using the Fibonacci indicator, which plots a series of ratios that represent potential areas of support or resistance. When we measure the rally from February 2025 high to the April 2025 low, the 161.8 extension lands at 69.59, which is very close to where the market just peaked. This number represents the golden ratio, a mathematical constant found throughout nature. It is a natural area where stocks are likely to pause their upward movement. It is also a target where algorithms and institutions are programmed to proceed with caution. And we are currently right at this ceiling. The yellow flag number 2 is sentiment. So let's look at how investors are feeling, not just what they're buying. We do this by looking at the VIX index. The VIX index is a widely viewed gauge of investor fear or complacency. It is a real-time index that measures the market's 30-day expected volatility of the S&P 500 based on options prices. In simplistic terms, the VIX can be viewed as the price tag for portfolio insurance because it reflects the implied cost of buying S&P 500 options to hedge against market moves. Currently, the VIX is near 16, which is a relatively low level. For context, the VIX reached as high as 78 during the COVID panic. So one might think that low fear sounds like a good thing for stocks, but extended periods of very low volatility can signal investor complacency and at times have preceded sharp market pullbacks. Many investors therefore treat the VIX as a contrarian indicator. A VIX reading in the mid-teens typically coincides with relatively calm markets and some degree of complacency, suggesting that fewer investors are actively buying insurance on their portfolios. History shows that such periods of calm and complacency have often been followed by episodes where sellers come in to take profits, leading to higher volatility and stock prices decreasing. Yellow flag number 3 is the Elliott wave count. The Elliott wave theory tracks the natural rhythm of market psychology. Its basic idea is that markets move in a 5-wave impulse sequence in the direction of the primary trend, and then followed by a 3-wave correction against that trend. So if you review the technical analysis published on major platforms like investing.com, along with the forecast from Elliott Wave International, there seems to be a consensus forming. Independent of each other, these experts are targeting a near-term window for a possible completion of a multi-year cycle. This work suggests that we are nearing the limits of that final 5th wave, the stage where even late buyers tend to rush in. This implies that the uptrend is mature, and we are now vulnerable to that 3-wave correction against the uptrend. So yellow flag number 4 is the geopolitics, or the geopolitical wild card. Unlike indexes, geopolitical risk cannot be measured until they occur. Right now we are living in a world of heightened friction, whether it's ongoing trade tensions or military conflicts in key regions. We do have headline risk. Any single event overnight can change the trajectory of the market instantly. And markets do not like this type of uncertainty. And we've also seen recently how one single headline about trade tensions can cause the market to drop more than 2%. Now, although the market has recovered from this scare, the geopolitical landscape adds fragility that doesn't appear anywhere on a balance sheet. So summarizing, our yellow flags are the Fibonacci extension resistance, the VIX complacency concern, the Elliott wave cycle and a possible 5th wave, and potential geopolitical risk. But this does not mean that a big market drop is imminent. What it does say is that we need to keep our head on a swivel. That means most of the surge from April could be completed already, and if so, the upside is limited and the downside risk is growing. Now let's review the macro backdrop, which presents a picture that is somewhat contrary to the yellow flags, in that the external factors that affect stocks are generally encouraging. The 10-year yield is hanging in around 4.2, 4.3%. 1 year ago, it hit 4.76%. And since August of 2025, it has been in a stable range from about 4.3 to 4.0%. And most major forecasts expect it to stay in this range over the next 6 months. The inflation outlook is also relatively positive. We have seen CPI numbers cool to around 2.7% year over year. Inflation has dropped steadily from the 9.1% that we saw in June of 2022. This drop from 9.1 to 2.7 gives room for the Fed to cut the funds rate a little more than they've already cut, from the current rate of about 3.5 to 3.75. Additionally, the economy grew at an annualized rate of 4.4% in the most recent quarter that was measured, up from the previous quarter of 3.8%. This is the fastest growth in roughly 2 years. This growth is driven by strong consumer sentiment, strong consumer spending, improved exports, and solid business investment. So there is no question that the U.S. economy is very strong and very robust. Additionally, oil prices are somewhat encouraging. Despite the military conflicts that we've seen in the headlines, oil prices are in an established downtrend since the COVID high of $130 per barrel was hit, and have dropped down to the current price of approximately somewhere around $63 per barrel. Lower oil prices act like a tax cut for every business and every consumer in America. So we do have a minor conflict concerning near-term market direction. The technicals and the geopolitics say proceed with caution, but the macro environment says the floor is still relatively solid. So how do we navigate this tug of war between the yellow flags versus the green lights being flashed by the macro outlook? Well, as always, it depends on your risk tolerance and your time horizon. Longer term investors who are younger are just now beginning their investing years can and should consider staying fully or mostly invested, particularly if they're contributing monthly to their account or their retirement accounts. By investing at regular intervals with a fixed amount, you automatically are buying more shares as prices drop if we do see a price dip. And this is an effective way to benefit from stocks over the long term. Now, if you were nearing or already retired, you might want to review your portfolio and evaluate exposure to stocks and consider if it is time to take a more defensive approach. At Blue Rock Capital, we have the experience and we have the ability to protect client portfolios by building a defensive wall around your assets. We do not just buy and hold and hope for the best, especially with our clients nearing or having reached retirement out already. We use active risk management to manage client portfolios, whether it is inverse ETFs, put options, moving more to cash, or other strategies. Our goal is to ensure that your assets are protective. As an independent investment advisor, my goal is to step back from the daily noise and look where we are in the market cycle using a disciplined and analytical approach. This is not about calling the exact top or the exact bottom, but understanding when the risk-reward profile is changing in a meaningful way. This means evaluating the market and making a determination on what the likelihood exists that over the next several months there is a probability that the upside potential is less than the downside risk. So if you're looking at your account statements and want to protect your gains, let's talk. My door is always open to discuss how we might protect together your financial future. Let's make sure your portfolio is prepared to weather whatever comes next in the near term and the far term. Well, I want to be very clear in what my message is today. First, the stock market is becoming stretched or extended, and it is a matter of time before we see a correction. Now, no one can predict when that correction will be or how much that drop will be. So the time to prepare is now. Thank you for watching.